Good morning, everyone, and thank you for joining our September investor call here at Stratosphere Capital Partners. As many of you know, my name is Leonard Lucas III, and I'm the Chief Investment Officer. And I would like to set the stage today by briefly walking you through the current economic environment and what it means for crypto markets. Over the past week, we've seen the Federal Reserve take a cautious step with a 25 basis point rate cut while keeping quantitative tightening in place. We started to see inflation measured by the Fed's preferred PCE index remain sticky at about 2.7% through headline and 2.9% core inflation. At the same time, what we're starting to see is consumer spending is still strong and GDP growth has been revised upwards. Jobless claims still is pretty low, and all the signs are saying that the economy um, is pretty resilient throughout the factors. There's a couple of things that I do want to talk to you about over this week, and we're going to share that with you in just a little bit. And so we're starting to see with the pulse of the American economy in real time. The story of this week, basically about the economy, is one of resilience, colliding with somewhat of caution. And on one hand, we're starting to see that consumers are still spending, factories are still producing great products, jobs are still being filled out. On the other hand, we're starting to see with the Federal Reserve and the nation's central bank is really pulling the strings with measured precision, adjusting interest rates to keep growth alive without letting inflation flare out of control. And to understand a little bit where we are, where we might be headed, we're going to talk a little bit about the headlines and the numbers that have dominated the last 10 days. We know in last week on September 17th, Federal Reserve cut its benchmark interest rate by a quarter of a percentage point. And when you start to look at that, you may think that lowering borrowing costs means more money flowing through the system. And that's true. But you start to see that the Fed language was very careful and very stern. Chairman Jerome Powell called it a risk management cut. In other words, this was not a sprint towards cheap money. And I think a lot of investors need to understand that this is not a sprint towards cheap money, and this is not a sprint towards lower rates. It's a cautious step. Basically, you have to think of it like a tightrope walker shifting weight without rushing in forward. So the Fed kept its pace in quantitative tightening. And basically, it's a slow process of shrinking the mountain of bonds and securities it brought through the pandemic. We know there was an over amount of investment in capital, buying through bonds and securities, MBSs during the pandemic. And so we're starting to see a slow process of shrinking those mountains of bonds. So the message that the Fed wants to send is they're easing a little bit, but don't expect the Fed to flood the economy with easy money, right? That hawkish note was cautious, cautious. Even with a moment of easing, they're having a cautious approach to this, right? And so when they begin to speak about that cautious approach, it begin really to ripple through the markets. Okay, so there's a couple of things I want to talk about in growth. We're starting to see the government revive second quarter GDP growth up to about 3.8%. And this was higher than the previous estimates of 3.3%. And this is not just a number, it is basically a signal that the US economy carried more momentum than the economists thought. And that's great. And basically, many people wanted to ask, Leonard, what fueled this upward revisions? It was primarily by the American consumer, and the American consumer has been really strong and resilient. People are still buying goods, people are still buying services, and no matter the price, people are still buying, and that's a good thing. Household increases, we see that spending at a pace of 2.5%, almost nearly a full percentage point higher than first estimated. Basically, in practical terms, people kept swiping their credit cards, they kept buying cars, they kept dining out, traveling. And in the economy where consumption makes up nearly 70% of GDP, that extra push matters enormously. And we're going to probably continue to see that throughout the end of this year. Um, so throughout that headline figure was a more complex reality, right? And that more complex reality was um, the final sales to private domestic purchases, basically, which strips out trade and inventory swings. So we started to see some slower momentum with that. Um, we started to see with business investment and begin to see some equipment side and housing markets remain subdued. And this basically gives us a takeaway that growth is real, but it may not be as sturdy as it looks on the surface. So there are numbers, hard line numbers on the surface, but we have to look at real growth, and the numbers are showing a different outlook than what we're seeing in the real economy. And so we are seeing still some growth in the economy, but it may not reflect to what the numbers are showing. And so we just want to let you know what that means. And I really want to talk a little bit about what that's going to do specifically moving forward and how that's going to look for crypto. And so we're really, really going to talk a little bit about that and going into inflation and basically showing us that the PCI numbers, the personal consumption expenditures, or the PCE index registered 2.7% year over year in August. That's slightly up from July at 2.6%. And so that core measure, which strips out food and energy, held at 2.9%. Um, so this gives us a translation that prices are still rising, but not at what we're seeing in 2022, which is good. So we're seeing, a tremendous, you know, in- let's say a tremendous continuous downturn on inflation from 2022. So we're still seeing prices rising, but they're not rising at the same level of 2022. And so the prices are also not falling fast enough. And so this created the Fed to make measures because when prices are not falling fast enough, uh, it's not allowing the Fed to be able to breathe easily. And so for you as a consumer, the experience is mixed. It's basically, business as usual. Prices are still the same. You're starting to see as prices begin to adjust to the high side with inflation, it hasn't really come down that much without uh, Fed using any type of measures to bring prices down. So basically, to explain that, it means households are basically treading water. They're earning a bit more, but you're also spending a bit more, and that also is continuing with sticky inflation. So the dollar, I'm going to talk a little bit about that. The dollar index, the DXY, climbed back towards 98.3, and that's was basically buoyed by strong GDP revisions and consumer data. At the same time, 10-year Treasury push around 4.18%. And why does this matter? Everybody asks. A higher yield means investors can earn more by parking money in government bonds. And that means risky assets like stocks and cryptos and high growth ventures are less attractive at this moment. Dollar strength also weighs on global markets, making American assets pricier for foreign investors. That's big for trade because when American assets are more expensive for foreign investors, that tightens financial conditions worldwide. We're starting to see over the last couple of weeks that for the crypto investor, there were macro forces that were felt acutely. In September in the third week, Bitcoin exchange traded funds saw net outflows, especially between September 22 and September 23rd, and basically staging a mountainous rebound on the 24th. Ethereum ETFs continued to bleed capital. So there was a lot of people selling out of the Ethereum ETFs and trying to buy more safer assets. Without that steady institutional inflows, we started to see momentum fading in crypto. Decline isn't about technology or adoption in crypto markets. It's really about the same gravitational force that pulls on stocks and commodities. And so a stronger dollar, higher yields, and a cautious liquidity conditions in this language, liquidity is oxygen. And when there's not enough liquidity in the crypto markets or in the stock market, you're going to see that high beta assets and high risk assets are going to struggle to breathe. We do believe that in the next couple of weeks that'll begin to normalize, but we just want to let you know that the Fed is taking a cautious approach. People seeing higher rates, higher yields coming into the capital markets, and what that means for higher risk assets for the short term. So many people are going to take out liquidity and take out capital to put them in some safe assets. Again, the roll forward lets us know that the economy is on this long highway. Uh, it's basically those days of the pandemic stimulus where the car was speeding really fast, fueled by trillions of dollars of fresh capital coming into the markets. Uh, we're now seeing an uncertain road where we may be on some slippery days. But the Fed is the driver of this, and whether they tap the brakes or they begin continually, ramming the gas, we're going to see, and we'll be able to give you some more information about that soon. So what we see right now, if there are going to be some opportunities for lower rates, and we do believe that that's going to happen, if the Fed can, with uh, lowering the rates down some more percentage points, we should see some opportunities for huge roads ahead in crypto. Right now, we're not seeing that. So just expect that in our business, in the fee business, liquidity provider business, fees are going to continue to go, but you might be having some short-term choppiness in that business. And so for that, you may see that in your principal balance, you might see a 3-4% drop in that balance. But we should see some adjustments coming in the next 10 to 14 days. So we thank you for September's investment video meeting. We'll be giving you more information coming in time soon. Thank you guys and have a wonderful day.